this up a little bit. All right, so this is the W-4. Like I said, I'm sure a lot of you are familiar with this. If you've started a job at any point in your life in the United States, you will have filled out one of these W-4 forms. The W-4, now this is, you can see they've got the year up here that it pertains to. They change this every year. If you look, I think let me see if I've got a W-4 from 2025. Let's see. So here's a 2025 form. It really doesn't have any changes on it from 2024. The reason being, from 2024 to 2025, we really didn't have any tax law changes. So there wasn't any need to change the W-4 form. Now, I'm going to show you when we go through the 2026 form, we have a lot of changes that are on it. And right now, this is just in draft form because we had a big tax law that was passed this year that changed the no tax on tips, no tax on overtime, and some other changes that did affect how the W-4 is filled out, some of the different factors on the W-4. For our purposes, in your problems, your assignments, we're going to use the 2024 edition of this W-4 form. Now, one of my suggestions is that when you're doing your problems, print one of these out and just kind of have it next to you, or if you have another screen, have it up so that you can look at it and reference it, because when we're going through this, you'll see, I'll show you where everything is and what each line means, but in your problems, it may just say, on line 3, in step 3, they have this amount. And you're kind of like, okay, what's step 3? What does it mean? So if you have it right next to you, you have easy reference to it. You can see exactly what they're talking about for each of these steps. All right, so first part of this is super simple. What's your name? What's your address? What's your social security number? So, and again, the employee fills this out. The employer does not fill this out. In fact, as the payroll professional or as the employer, HR professional, whatever position you're in, the person who's inputting this information, you cannot help them other than to say, this is where you put your name, this is where you put your social security number, this is where you choose your filing status. If they have a question like, well, I don't know what my filing status is, what's my filing status? You can't help them answer that question. You have to direct them to a tax professional in order to answer that question. Because otherwise you're giving tax advice, and you're not allowed to give tax advice unless you're a tax professional. Now, once you're like a CPA and you're in the profession, then you can go ahead and do that. But for most payroll professionals, they can't give that advice other than to say this is where you put that information. Okay, so first piece of information up here is super simple. Like I said, name, address, social security number. All right, bang. This part is actually sometimes really hard. This pertains to filing status. So, and it pertains to the filing status that's going to be used on the tax return. So, if you, and this may change. So, if an employee filed as single last year in 2023, that doesn't necessarily mean that in 2024 they're single. If they got married, they're no longer single. So it pertains to whatever their filing status is at the time. Okay, so you can see there are 5 filing statuses, and you're going to work, when you take income tax accounting, you're going to learn this stuff in detail. There are 5 filing statuses. You can see, though, there are 3 boxes, even though there are 5 filing statuses. That's because for a couple of these filing statuses, single and married filing separately, the calculation's the same. The numbers are the same. Where we pull the information off of the charts is the same. Same thing for married filing jointly qualifying surviving spouse. The information that is the amount of the calculation is the same for those filing statuses. So let's take a look at these filing statuses. So first one we have is single. And filing status always pertains to what your filing status is on the last day of the year. So if you are single the entire year, but you get married on December 31st, that means that you are married, considered married for tax purposes for the entire year. So if an individual, like if a employee is single when they get hired, but they're getting married next month and it's still in the same tax year, well, they may want to, well, they'll probably want to choose single for right now, but they're going to want to change it once they get married because now their filing status has changed. And that will change the amount of withholding. Yeah.
If you're married, do you have to file as married?
So yes. But there are two different filing statuses for married. There's married filing jointly and married filing separately. So, yep. And there are a couple of little nuances I'm not going to get into in this class. In income tax, we talk a little bit about that. Filing status, even though it's like one of the first questions that's asked on the tax return, it can be one of the hardest questions to answer because there's so many nuances with it. And I always, I tell my income tax students, look, this is based on human relationships. And human relationships are complicated and they're messy. And so therefore, this can sometimes be really messy too. 9 times out of 10 it's clear cut, but it's that 10th time that becomes complicated. So the first, single. If you're single, when you fill this out, you would list that you are single. That's the box you would check. If you're married, filing separately, like I mentioned, if you're married, there's two filing statuses. You could be married filing separately, which means you and your spouse file separate tax returns. You are married, but you do not file tax returns on the same, you don't combine your income, you don't combine your deductions onto one tax return. Multitude of reasons for that. Could be that you're getting divorced and you're not getting along with that person, but you're not divorced yet. And so you're going to file, you don't trust the other person or what have you. You don't want them knowing your stuff. So you're going to file a separate tax return. There are other reasons as well. I had clients who it was just a better tax advantage to them that they could, it was better for them from a tax perspective to be married filing separately. Most times it's not an advantage, but there are certain rare times when it is an advantage to choose that filing status. I had clients who, it was their second marriage, they were retired, they each had everything separate. They get along with each other, that's not a problem, but they got each of them has their own kids and their own grandkids, and they just don't want to combine any of their finances. They don't want to combine any of their income, so they would file separately. Even though it may be a tax disadvantage, there may be other emotional reasons that it may be an advantage. So that's one of those filing statuses. But if the individual is single or married filing separately, they're going to check that first box. Like I said, the information on the tables and in the schedules are both of these, it's the same information, the same numbers come out. Next up is married filing jointly or qualifying surviving spouse. So married filing jointly, you're married and you are combining your income and deductions together onto one tax return. So you don't have to file two tax returns, you're just going to file one. You're going to add all the income up, you're going to add all the deductions up, and then you're going to apply the married filing jointly rates to that. Qualifying surviving spouse, this is an individual who within the 2 years after becoming a widow or a widower, and they have a dependent child, they can then file as a qualifying surviving spouse. What it allows them to do basically is get the benefits of married filing jointly for the 2 years after their spouse passes away. So in the first year, they actually will file as married filing jointly. So if a spouse dies in 2025, this year and they have a qualifying child, a qualifying dependent, they would file as married filing jointly this year. But then for 2 years after, so for 2026 and 2027, they could file as a qualifying surviving spouse. It's a tax advantage that they get for those 2 years. Then after that, they're either going to file probably as single if they didn't get remarried. If they got remarried during that time, then they're just going to go back to married filing jointly or married filing separately. But if they don't get remarried, they're probably going to file as either single or as head of household. Head of household is an unmarried individual who has a qualifying dependent. So, and this is where it gets really tricky. When you've got employees who are like, well, I'm single, but I have a kid. Am I head of household or am I single? You really can't answer that question for them. They need to talk to their tax advisor, because here's the requirements. Check only if you're unmarried and pay more than half of the cost of keeping up a home for yourself and a qualifying individual. What's a qualifying individual? There's a whole list of rules for whether or not somebody's a qualifying individual. So the good news from a payroll perspective is that you can just tell the employee, you're going to have to check with your tax advisor, right? If you are a tax advisor, the bad news is you got to figure this stuff out. You got to figure this out for clients. And I would have, by the way, I would have clients as well that when they start a new job, they'd call me up and say, hey, I'm starting a new job. Can you help me fill out my W-4 form? So as a CPA, I could do that. And I would help them to fill it out appropriately for their filing status. But again, you can see how this is individualized now, because this is the second piece of information that we need in order to do the calculation, is what is the filing status. This comes right off of the W-4 form, and this is individualized for each employee, plus it can change over time. So if an employee's status changes, if they go from single to married, or they go from married to single, or their spouse passes away and they have a qualifying dependent, then they're going to want to fill out a new W-4 form, because it's going to change their withholding. It's going to change how much is being taken out of their paycheck. All right, so this is just step one. Step two, now, these only have to be filled out if they apply. So the first one is a question about multiple jobs. So if you as an individual have more than one job, or if you are married and your spouse also works, then you may need to fill out this form. Now there are 3 different options under this step 2. Complete this step if you hold more than one job at a time. So you've got a main job and a side hustle. That's a job. That's a W-2 job. If it's self-employed, that's a different, well, if it's self-employed, then you still want to fill this out, but you may have a little bit more complex calculation ahead of you. If you want to pay the taxes for that self-employment through this job. If you want to pay it separately through estimated payments, then you don't have to use the W-2 or the W-4. So if you have more than one job at a time, or you're married filing jointly and your spouse also works. So if you're married filing separately and your spouse also works, you don't need to do this, okay? Because it's like you're single. If you're married, from a tax perspective, it's as though you're treated as though you're single and you only have one job. So if you're married filing jointly and you have 2 jobs, then yes, you want to fill this out. So the correct amount of withholding depends on income earned from all of these jobs. So the calculation, now the good news is you're not doing the calculation, the intricate calculation of this, the employee is, okay? And if in these 3 different options, we are actually, for this class, we're worried about the simplest one, okay? But I want to go through what these 3 different options are so you're familiar with them. Do only one of the following. And by the way, so I know we talked about some of those test questions and the wording was complicated, and or you know it was really not really clear. Another reason that they're like that is because the instructions for these forms, you have to read every single word. And it can also be, you've got to follow along with it, and it's got to be really, so it's, It's another reason that why reading everything very carefully is so important. All right, so do only one of the following. All the instructions are up here, by the way. I mean, in the form. They're there. All the calculations, it's all there for you. So one of the following. Use the estimator for the most accurate withholding for this step. If you or your spouse have self-employment income, use this option. Again, if you want that considered in your withholding. When you're self-employed, you also have the option of just making estimated payments separately from this. But if you want it included in this, if the employee wants it included, then they would use this estimator. So this is what the estimator looks like. Let me get to the beginning of it. All right, so if you were to click on that, this is where it takes you. Filling this out is almost like just doing a tax return, filling out your tax return. All the questions that it asks here are tax return type questions. What's your filing status? Do you have any dependents? What's your income? Will you have, let's see, do you have a job that withholds federal income taxes? Yes. Select any to apply. I plan to claim dependents. Okay, sure. Now it's going to ask you information about your income. This is a really involved process, and what it does is it goes through all of these steps, like I said, kind of like doing a tax return. Like if you've ever used TurboTax or one of those programs, H&R Block, it asks you a series of questions. This is very similar to that, but what it's going to do at the end is it's going to spit out a number, and then that's the number that you just put on the W-4 form. Essentially, now the employer is just going to withhold that amount every paycheck. That's what they're going to withhold. So it's getting an estimate of what your tax is going to look like for that year, what the employee's tax is going to look like for that year, what their liability is going to be, and then it's going to spread that amount out over all of their paychecks. Okay? That's the estimator. Very few people use it, but it does give, it gives a very accurate answer as long as the information is accurate. You've heard the phrase garbage in, garbage out? So if the information that's being inputted into it is not accurate, turns out not to be accurate, then of course the information that it spits out is not going to be accurate. So it's only as accurate as the information that is entered into the system. So that's the first one that you could do. Second option is to fill out a separate worksheet, which is attached to this W-2. This is called the multiple jobs worksheet. It's right here, so there's 4 lines, but you can see there's kind of some sublines here. And again, this is only if there's multiple jobs. If you've only got one job, you don't have to worry about it. You only have one job and you're single, you don't have to do any of this stuff. But if there's more than one job, then you have to fill this out. Again, all the instructions are here. I'm not going to go through this one in detail, but this is the same concept as the estimator, but you put in more general information. So now we're kind of getting to, it's not as accurate because you're not entering as much information, but it's still supposed to kind of get you into the ballpark of what needs to be withheld. Okay, and again, so if the employee fills that out, the ultimate number that they have down here in their last step, they're just going to pop that number onto the front of the W-4, and that's the amount that the employer is going to withhold. Every single paycheck, that's what they're going to withhold. So that's the second option here. That's B. Now, option C, and luckily this is the option that we use, okay, is if there are only 2 jobs, so you and your spouse each have 1 job. You, as a single person, only have 2 jobs. So 2 jobs total. You don't have 3 jobs or more than that. But if there are only 2 jobs, you can check this box. Box is right there. Do the same thing on the W-4 for the other job. The other job is going to have a W-4 as well that's been filled out. So you do it the same on both of them. Check the box. This option is generally more accurate than using the multiple jobs worksheet if the pay at the lower paying job is more than half of the pay at the higher paying job. What that means is, so if you've got 2 jobs, You make $50,000 a year at one job. You make $30,000 a year at the other job. Well, $30,000 is more than half of $50,000. So it meets that criteria. You can check this box. Or two spouses, one spouse makes $50,000, the other spouse makes $40,000. $40,000, the lower paying job is more than half of the $50,000. So you could just check this box. If that's not the case, it doesn't mean you can't check the box, but using B is more accurate. Using the multiple jobs worksheet would be more accurate for the employee. They don't have to fill that out, but they could just check this box. But if they want, they can fill out the multiple jobs worksheet. So if you're married filing jointly and you make $50,000, your spouse makes $40,000, you're just going to check the box. This is the option that we're using in this in our problems. Okay, this is the third factor that I have down here listed of information that we need. Comes from the W-4. Is the box checked or is it not checked? And you'll see when we do our calculations and when we use the table where that comes into play, where that information comes into to be one of the factors that we need. All right. Now, step 3. So that's step 2, more than one job or less than one job. This says here, complete steps 3 to 4 for only one of these jobs. Leave those steps blank for the other jobs. So your withholding will be most accurate if you complete 3 to 4 on the form W-4 with the highest paying job. So if you've got more than one job, you're only going to complete these for one of the jobs. Steps 3 and 4. And they may not apply to you. You may or may not have to, the employee may or may not have to fill them out. Step 3 is for employees with dependents. So if the total income is $200,000 or less, $400,000 or less if married filing jointly. So there's one example of where filing status comes into play. So if you are any other filing status, the threshold is $200,000. Married filing jointly, the threshold is $400,000. What that means is individuals in those filing statuses with income higher than that are not eligible for these credits. They can't get them. These credits pertain to credits that are available on the tax form. So the first one is the child tax credit. So multiply the number of qualifying children under age 17 by $2,000. On the tax form, on the 1040, there is a credit for individuals who are under these income limits for each child under that age who is a dependent of theirs. So they get $2,000 credit. It's as though they paid in $2,000. So they get, it's direct dollar for dollar, $2,000 for each of those qualifying children. But the age cutoff is under 17. Just when they start to get really expensive, they take it away from you. I know I have a child who's going to be 17. So, and this is the last year we're going to get this for him. So under the age of 17. So if your child turns, and it's under 17 as of the end of the year. So if your child turns 17 on December 15th, you don't get the child tax credit anymore for that year. What these credits do, essentially, it's adding up, and you're getting, like, it's like you're getting them as a prepayment. So it's going to get spread out as a reduction in your withholding throughout the year. Okay, so instead of getting the benefit of it, you still claim it on your tax return, but that credit's already been paid to you in the form of reduced withholding throughout the year, right? So these two credits, so under age 17, multiply by 2,000. So if you have two kids that are, let's say they're 14 and 12, multiply that by the 2,000, you get $4,000. $4,000 credit. This credit for other dependents, so this is the consolation prize once your kid turns 17 and they're still your dependent. So if you have any other dependent, and it's not just children that can be dependents, it can also be elderly parents or grandparents. The rules for who is a dependent are pretty complex, and it's not just children that might qualify. But multiply the number of other dependents by $500. So that kid that turned 17 on December 15th, all right, he's not going to qualify for that $2,000 credit, but he'll qualify for the $500 credit. So it'll at least reduce your taxes by $500. So you multiply the number of other dependents by 500, and then you add those two boxes up here. And like I said, what that's going to do is it's going to spread out the value of that credit over the course of the year. Employees don't have to take this if they don't want to, because what it's doing is reducing withholding. It's not increasing withholding, it's reducing it. And if they don't want to reduce their withholding throughout the year, they want to instead wait until they file their taxes and get the benefit, then they can do that. So they don't have to fill this out, but it's there for them. So add the amounts above for qualified children and other dependents. You may add this amount to the amount of any other credits. So what that means, there are other credits as well. There's a lifetime learning credit. There's a American Opportunity Credit. There's all sorts of different credits that are available. If the employee knows what those credits are, they can also add that in to this number here. And again, what that's doing is it's just giving them that benefit, that tax benefit, at the point of withholding rather than waiting until April 15th when they file their taxes and getting that at that time. Now, a lot of people, though, like to get their big refunds, and a lot of refunds are dependent on these credits. So, the employees may want to think about whether they prefer to get the refund at the end of the year or if they want to get that spread out over the year. Claiming it here will spread out that credit over the year, and that's where they'll get the tax benefit. So that's step 3. Any questions right now?
Yes.
Mm-hmm.
It has a little something. So, like, my son was in Iowa. I had to fill out, even though like they paid for his education, they only paid for what financial aid did.
Right.
So I had to file them, I got to fill out the FAFSA for him. So, but I let him claim his own taxes.
Okay.
The right thing to do is
I can't tell you without knowing that's okay. Without knowing the specific situation, I can't tell you. It was, he's filing. That means you're not getting the benefit of him anymore. Yep. Yeah. Yeah. Without knowing the specifics, I can't really tell you. No, that's okay. That's okay. That's a very common question, though. Once kids get to that age, you just kind of wonder, do I keep claiming them, or should they be claiming themselves? And it's a very individualized answer, and most tax preparers what they would want to do is look at the financial situation of each, the parents and the child, and kind of do a side-by-side, what would happen if it was separate, what would happen if they were still claimed as a dependent. Yeah, you bet. Okay, so that's step 3, has to do with dependents and those credits. Step 4, other income not from jobs. So if you want tax withheld for other income that you expect this year, but there won't be any withholding. So things like interest income, dividend income, rental income. If you have some other source of income, but there's not going to be withholding from it, like maybe you've got retirement income or Social Security income that's going to be taxable, you can add that income here, and the withholding calculation will then include that income. It will take it into consideration. So here, with this part A of step 4, we are adding to the amount of withholding because we're adding to the income. Essentially what it's like is we're going to add to this number here. We're going to make this number bigger, which is going to make this number bigger, right? So, but we're adding other income from some outside source. Again, only the employee can knows that information. The employer doesn't know that information, which is why it's up to the employee to fill this out accurately and in full. All right, so any other income not from other jobs, because you would have a whole different W-4, right? You're already getting withholding from that job with a different W-4. Part B is any deductions. So if you expect to claim deductions other than the standard deduction, and I'll give you a little more information about what that is here in a second, and you want to reduce your withholding, there is a separate deductions worksheet. So we looked at the multiple jobs worksheet. There's also a deductions worksheet. It's only 5 steps to it, and what it does is you enter what you think your itemized deductions are going to be. I'll talk about those in just a second here. You compare it to what the standard deduction is, and whichever one is greater, that's what you're going to get to use. So the standard deduction, every taxpayer gets some sort of well, I shouldn't say every, there are exceptions. The answer, by the way, to any tax question is it depends, because there's always an exception to some rule. But generally speaking, taxpayers will get some sort of deduction, which means it reduces their taxable income. So they start with their gross income, and then they get to subtract some amount from that to arrive at their taxable income. So the standard deduction is just a flat amount, and it's based on filing status. So in 2024, $29,200 was the standard deduction for married filing jointly or for a qualifying surviving spouse. So that widow or widower who had a dependent child, that was the deduction amount. So if you had $100,000 of total income, you'd get to subtract $29,200 from that $100,000 to arrive at what your taxable income is if you're married filing jointly or a qualified surviving spouse. The amount was $21,900 for head of household, so a little bit smaller amount. For single or married filing separately, the amount was $14,600. So you get to just subtract that right off the top. That amount is not going to be taxed of your income. So it helps to reduce your taxable income. But what you can do, there are also this category of what we call itemized deductions that you can total those up and compare it to the standard deduction. If your itemized deductions are greater, then that's what you can take. So whichever is the greatest tax benefit is what you get to take. Itemized deductions, and it says here from Schedule A, Form 1040, itemized deductions are on what's called a Schedule A of the regular tax form, the individual tax form. Deductions such as home mortgage interest would be included in that, up to 2 homes. And if you have a loan against those homes and you paid interest, then you can deduct the interest on those homes. Charitable contributions, so amounts that you contribute to charity. That example of the United Way contribution that is post-tax, so that I used earlier. So we had an employee who had their employer deduct a charitable contribution from their wages. It's post-tax, meaning they're not going to get an immediate tax benefit from it. If they itemize their deductions, they can include it under the charitable contributions. That's where they get it. But not everybody is going to itemize their deductions. In fact, most people don't itemize deductions. Things like state and local taxes, so income taxes and property taxes are included in this bucket. And then medical expenses that are over 7.5% of your adjusted gross income. By the way, I don't expect you to remember the details of this. I'm just giving you a kind of explaining the background of all of this. All right. When you take income tax accounting, I will expect you to remember it. But right now, I don't expect you to remember these things. So what happens is the employee will total up all those itemized deductions, compare it to the standard deduction, and whichever one is higher, that's what they can use. Okay. So what this worksheet does, is it works through that. It goes through that whole step for the employee to then do the calculation of which one is going to be greater. So if they want they can take, if they're going to itemize their deductions, they can do the calculation to determine the additional amount that they can then deduct from their and factor into their withholding. So they can get that tax benefit up front if they want to. Probably most employees that are eligible for this probably don't take this. This is a pretty complex calculation that's done. And also, most taxpayers do not itemize their deductions. The vast majority don't itemize their deductions. Most of them take the standard deduction because that's what's most beneficial to them, right? But that's what that means. So if you expect to claim itemized deductions, that's what they mean by deductions other than the standard deduction, itemized deductions. You want to reduce your withholding, use that worksheet, and then enter the result from that worksheet here. Last line, extra withholding. If you go through all of that and you decide, you know what, I think I need to have some more withheld. I still am not comfortable with this. I owed last year and the year before, and I really hated owing. I just want to make sure that I don't owe at the end of the year. You can just enter in any additional amount that you want withheld from each pay period. So this is not an annual amount here. This is from each pay period. So you can say, you know, I just want an additional $50 every pay period withheld so that I've got that cushion. You know, or if you didn't, like, maybe you have other income, but you didn't want to go through this calculation of it and list it separately, you could just say, okay, I'm going to just put the additional amount here. So what that does is the payroll department will then do all the calculation that's required, and then at the very last step, they're going to tack on an additional amount that's withheld. Okay? The last part of this, step 5, is where the employee signs it. And notice it's under penalty of perjury. The employee has to fill this out honestly. They can't say that they're married filing jointly, but they're actually single. They can't say that they have 2 dependents and they really don't have any dependents. This is under penalty of perjury. By the way, the tax form says this as well. This is the part that allows them to charge you with criminal intent if you intentionally misstated what it is, right? Misstated it. So under penalty of perjury, I declare that this certificate, to the best of my knowledge and belief, is true, correct, and complete. Signed by the employee. Employer, they don't have to sign it, but they just have to fill this information out. So date of employment, their employer identification number. This form doesn't go anywhere. It stays with the employer. But if the IRS comes and does a spot audit, or they ask the employer to send in a copy of the W-4, the employer has to have this on file. Because if there's any question about the amount of withholding, that's you know, if they've got an individual who year after year after year has very little or nothing withheld, but they always owe tax and then they never pay their tax, or they set up installment plans where they're paying $25 a month and yet they owe tens of thousands of dollars, they're going to want to know what's on that W-4, because chances are they probably committed perjury somewhere. Right? So it's a legal document that employees are paying. So one of the things, so all the instructions, well, I mean, there are more instructions than just this one page, but there are instructions here, line by line instructions that give general guidelines on how to fill this out that are on page 2 here. That multiple jobs worksheet and the deductions worksheet are on page 3. This is not the table that we're going to use, by the way. This is for something else. So don't pay any attention to the tables that are on the last page there. What you would want to do for purposes of homework, like if you're going to print this out or you're going to save the PDF or whatever, just the first page is enough, just so that you can look back and say, you know, if it says, you know, in step 2, part C was empty, you'll know that, oh, that's the checkbox, because you can just look at the form and see it. So one of the things I wanted to point out as well is, like I said, it changes every year. And this is kind of interesting. I hadn't looked at this before today. This is the draft copy for 2026. Now, like I said, between 2024 and 2025, there really weren't any changes in the W-4 form because there weren't any tax law changes. Well, we have some big tax law changes that affect employees and their withholdings starting in 2026. The no tax on tips, no tax on overtime. Also for senior citizens, those who are 65 or older, there's an additional deduction that they're going to get of $6,000 for each individual on the tax return. Well, for each taxpayer that's over 65. So that means that the W-4 is changing. This is the draft copy. They don't have the final one out. They'll need to get this out before January 1st, but I suspect we have a government shutdown right now, and a lot of people are furloughed, and so right now nobody's working on this, but we have a lot of tax forms that are changing next year. I suspect that the tax season the start of it may be delayed because of all of this. The first thing that you can see that's changed, so remember the dependent, step 3, dependent and other credits. Notice on the 2024 and 2025 form, the number was multiply the number of qualifying children under the age of 17 by $2,000. Well, here it's listed as XXXX. That's because one of the things that changed, and it's a temporary change, is that was increased to $2,200. So the child tax credit was increased to $2,200 starting in, actually I think it's starting this year, but it's going to show up on the as part of the W-4 next year. So people will get it when they file their taxes in 2026, but they won't get to account for it on their withholding until 2026 starts. So this number, it says just XXXX because for a while it was going to be 2,500, but I think they settled on 2,200. Each of those numbers, they have to multiply it by the number of people who are using it, and can they stand that much reduction in revenue? They've got to do all those. So that's one of the changes right there. Same information here with step 3 and step 4, but take a look at the, so here's the multiple jobs worksheet. That really hasn't changed. But the deductions worksheet, so 2024 deductions worksheet was five entries, right? 5 lines. 2026 is 15. That's because those items, such as the qualified tips, the no tax on tips, there are restrictions to that. It depends whether you get that or not. You have to be in a tipped profession as defined by the IRS, what a tip profession is. You can't have, your AGI has to be below a certain amount, 150,000 I think for a single, 300,000 for married. And it's only on the first $25,000 of tips. It's not exempt from Social Security and Medicare tax. It's only exempt from income tax. And it's not exempt from state tax. So you'll still have to know how much your tips were, but you can exclude up to $25,000. So it becomes part of the calculation. The no tax on the qualified overtime, again, it's and I don't know what the details are on how they're going to do that on the W-2 forms, but again, same income thresholds, but qualified overtime, then if you think you're going to have overtime, that can be factored in to the calculation. That let's see. Car loan interest. If your income is below certain limits and your car is made in America, you can exclude interest on that car loan. Now there are, like I said, there are these restrictions. Again, the answer is it depends. Seniors age 65 or older, because they're still working, a lot of them, they're going to get that $6,000 deduction. That now factors in as well to the deductions equation. So this becomes more complicated because of those tax law changes. So every time we have tax law changes like that affect how withholding is calculated, that factors in, that's going to change this W-4 form. And you're going to see this as well when we go through the W-4 from before 2020. This W-4 that we just looked at was implemented, this whole format was implemented in 2020, and it was a result of tax law changes that occurred in 2018. So it took them a year to develop a new form for it. When we look at the very end of this chapter, we're going to look at that old form and what it was. And many of you, if you had a job before 2020 and filled out a W-4 form, it looks a lot different than this. It's a lot shorter. Yeah, it was just it was like a third of the page. And it had some different, these are our 4 factors. It didn't take into account filing status. And it didn't have this checkbox as part of it. We still needed to know what our taxable base was and how frequently we were paid, but there were a couple of other factors that were in on that W-4 form from before. So this changes when there are changes to the tax law that affect employee wages and what's taxable. All right. So that's the W-4 form. Any questions about that? That's an extensive tour. Even if you've filled them out in the past, I'm pretty sure you haven't gone through in that much detail all the information that's on that W-4 form. So again, I recommend you print it out. I'm going to do just a little intro to